Eric Sterner is with us, Chief Investment Officer at Apollon Wealth Management. Thanks for being here.
Oh, thanks for having me.
So you were talking about the Santa Claus rally. Did it come early or is it going to continue? What's happening?
Yeah, it definitely came early this year, and I think there's definitely a lot of good news in the markets between breaking out of that earnings recession. We finally got after 3 negative quarters of negative earnings. We broke out of that in the third quarter. We saw the bond yields drop a bit, which took some pressure off the equity valuations. And we continue to see some progress on inflation. I just think the celebration was a bit too much, and I think that's why the market's taking a bit of a breather now, because we can argue and all we want, as many people do, whether it's a hard landing or soft landing, but I think we all can agree that the economy is slowing down, and that's the intention of all these rate hikes by the Fed.
So when you say the economy, when you say the market's taking a breather, look, we've had 5 weeks of gains, and I've heard that. I heard that yesterday as well about profit taking. Is that just now for a few days, or do you think we could see another pop between now and Christmas or New Year's?
Potentially. I think right now the valuations are a bit stretched. We see some analysts starting to downgrade their earning per share estimates for the fourth quarter. And potentially with the labor report coming out on Friday, with CPI report next week, that could give another pop. But in my mind, I think we're going to be trading in a narrow range, and I think we're at the upper bound of that range right now. Because just going back to what I was saying before, analysts have deducted the earnings per share estimates for the fourth quarter, which is not unusual. It happens almost every quarter. But in the first 2 months, they've decreased those by 5%, which is more than double the decrease over the past 10 years. So they're really starting to decrease earnings estimates, and I think that's why I think we're kind of at the top end of that trading range we may be in for a bit.
Right, I see. Okay, and you are concerned about the consumer. You just we're talking about different things. I mean, mortgage rates are still very high. Inflation, I know you said it's coming down, but credit card rates, defaults, things like that. So that being said, what do you advise to folks? Chief Investment Officer, are you seeing any changes or stay the course, or what do you tell them as far as where to put the money to work?
Well, I think that there's a lot of mixed news in the markets, but I think we're obviously seeing some strong returns over the past month. And I always recommend to stay invested. I would just advise clients to focus more on quality companies that have strong balance sheets, strong cash flows, because we have tighter lending standards. Consumer spending is most likely going to drop, so we want companies that could weather that economic slowdown. What I also like right now is more dividend-paying stocks. If you looked at the last 30 years, when Treasury yield or the 10-year Treasury was between 4% and 6%, dividend-paying stocks outperform the broader S&P 500, and that helps when you're in the trading range, which I think we'll be in, because I don't think the Fed's going to cut rates. I think the market's getting a little ahead of itself. I see right now Fed futures predicting a 50% probability that the Fed's going to cut rates in March, and I think that's way too optimistic. I think we're going to wait until the summer, because the Fed's going to want to see a sustained downward trend. And while there may be people out there who may be declaring the inflation fight is over, all that matters is when the Fed makes that declaration and starts cutting rates.
Yeah, so you don't see that as soon as some others are seeing it. That being said, do you have, because when you talk about dividend payers, quality, strong balance sheet, do you have names or sectors or ETFs that would stand out to you that you would say you could like in that fashion?
Yeah, well, I think, because this year there's been such a strong dispersion between growth and value stocks, I think a lot of more growth-oriented sectors are at that high end of valuations. So I think there's a lot more better valuations on more value-oriented stocks, financial institutions.
Right.
I also really like fixed income now, because fixed income is setting up for some strong returns. It's been getting beat up over the past few few years.
What kind of bonds are you looking at?
Treasuries, investment grade, knowing that we're going to economic slowdown, potentially recession, and if we do get in a recession, we could see some high yields, their spreads blow out. So we're seeing a lot more clients build out those bond ladders. They're tempted to stay in those money markets that are paying 5%, but we're advising them, hey, that's great, but those rates are going to go down once the Fed starts cutting rates.
Right. What about when you look at equities, large cap, mid cap, small cap? Do you lean toward, when you talked about value, is it just sort of anywhere in there, or are you leaning more towards one over the other? I mean, we've obviously had the tech stocks jumping, energy's been out of favor the last month or so, but is there anything that jumps out of you of those?
We're staying, well, right now we're at neutral to our small cap relative to our benchmark. And although the valuations are extremely attractive, the PE ratios as compared to the large cap, knowing we're going to economic slowdown, that's why we don't want to really overweight into small caps yet. I think once we kind of get past and get the inflation target closer to the Fed's 2% rate, or closer to the Fed cutting rates, that's when we might go overweight on the small cap side. But as we go into potential economic slowdown or recession, knowing that 40% of the stocks in the Russell 2000 are unprofitable, and we have tighter lending standards, that's where we just want to maintain our position, but be neutral as opposed to going overweight right now.
Right, understood. Great to see you, Eric. Thank you so much. Eric Sterner of Apollon Wealth Management.